Introducing Period Entry AI Accounting. I started my career as an equity analyst, and as such I was a financial number super user. But I have also been a number crunching, bin counting accountant. This has given me a unique perspective. I remember talking to the head of audit about alternatives to double entry, and he said you will make another system just as complicated. But I started with theory, and the theories became algorithms, and the algorithms became designs, and finally code. In all, it has taken me 10 years to carve out a new design. It was a slow process of chipping away at the old system and discovering the new. I stuck to the belief that accounting is an informational science, so information technology can transform accounting absolutely. The problem with double entry is manyfold. Double entry is batch-based. Each month, quarter, year, adjustments are added one on top of the other. Supporting schedules must be created. Forecasting is also batched with the need to create separate human resource plans, sales plans, capital and operational plans. And the budgets are quickly out of date. Double entry is complex and counterintuitive. Traditional accounting creates silos of financial information inside the finance department. We don't need a special advisor on how to use Excel, so why should we need them for accounting? The fragmented nature of accounting and complexity of the process of recording accountancy's adjustments means extensive and expensive audit. There are 3 different types of double entry: the invoice, payment, and the adjustments in the general ledger. Where the invoice income or expense spans across several reporting periods, adjustments are made in the general ledger, moving the invoice value from one reporting period to the next. These adjustments are checked for correctness, reconciled, using supporting schedules such as Excel. The purpose of bookkeeping is to resolve the issue of payments incoming and outgoing that fall into different reporting periods. The bookkeeping problem is one of timing. There is a very simple solution to all this complexity that I call period entry. A single period entry encapsulates all the information in the invoice transaction, payment transaction, and the general ledger and supporting schedules. The best way to understand a period entry is through a visualization against a timeline. The example here is an insurance contract that lasts 1 year with a work start date of the 1st of January and a work end date of the 31st of December. This is the blue line. The payment date is represented as an upturned triangle in black. In order to create a financial statement, we need to add a report period, the red line. The report period starts on the 1st of January and ends on 31st of March and lasts 90 days. So here the blue line represents the life of the item and the red line the period of reporting of this item. We are interested in where the report red line crosses over the work blue line. This crossed over portion of the work period is now colored red. The crossed over portion represents the work done in the reporting period. It is 90 days and the work lasts 1 year, so the portion reported is 25%. The total value of work is £1,000. Therefore the work done in the reporting period is £250. For a customer this is an expense of £250, and for the supplier it is an income of £250. The algorithm that calculates the crossover value is based on minimum and maximum calculations of the work start, work end and report start and report end dates. It calculates the proportion crossing over and multiplies by the value of the transaction. The next thing to calculate is the amount paid. The logic here is that if the report end date is greater than the payment date, then payment has been made. For example, the report end date is the 31st of March but the payment date is the 1st of January, then the payment is made and is equal to the total value of work in the period entry, which is £1,000. So we know the work done and the work paid for. The difference between these two numbers is crucial. It is your financial position. If a supplier has done work but has not yet been paid, the supplier is owed money and the customer owes money. If the supplier has done part of the work but has been paid in full already, the supplier owes work to the customer. In the following case, the first quarter's insurance has been received. This is 25% of the 12-month £1,000 contract. It is worth £250. However, in January the entire year's worth of the insurance contract was already paid. This means there is work outstanding. An advance of £750 has been paid by the customer to the supplier. In the next case, the first quarter's insurance has been received. This is 25% of the 12-month contract. It is worth £250. However, the entire year's worth of the insurance contract is paid in June after the reporting end date of March. This means again there is work outstanding. The customer owes £250 to the supplier. Any scenario of work and payment is possible. The double entry logic is adhered to. The financial performance, income or expense, and the financial position, profit and loss, payment and outstanding work, are calculated on the fly. There is no need for the general ledger or supporting schedules. But how can you be sure that all the numbers add up? Accountants add up all the debits and credits to ensure the values are correct. In period entry, reconciliation is much easier and more intuitive. You merely need to make sure that the total work is equal to the total payments in each period entry. Benefits of period entry. Easy to understand. The benefits of period entry is that it is easier to understand than double entry because it can be visualized in an intuitive way. Any time period. It is continuous in that it can be reported over any time period, be that yesterday, last 7 days, last 30 days. One single entry. Period entries are single entry. There is no need for separate entries for forecasts and budgets. Forward-facing. Double entry is backward-facing. Period entry is forward-facing. As it is based on work periods, these can be just rolled over into the future. Instant compliance. Period entry makes compliance with accounting standards instant. Simplified costing. Costing, the allocation of income or expense to a particular department or project, does not take new entries. The period entry is just updated. There can be multiple versions of a period entry. This means multiple versions of costings can be made. Audit at low cost and more effective. There is a greatly reduced need for audit. As period entry is a continuous system, audit can become continuous with an audit team dropping in at any time. The audit would be just checking the periods on the period entries. This de-skills the work of an auditor. Most of this period checking could be automated. Automated consolidation. Consolidation is completely automated. In a large multinational, all of the transactions can be held in one database and intercompany transactions are instantly eliminated. The single database means the business can create accurate models of the business where a variance only matters when it changes the model. Conclusion: an accountancy revolution. Period entry is an accountancy revolution. Period entry dramatically cuts the cost of accountancy and audit and creates near-perfect information for companies. Period entry is not just an alternative to double entry, it makes the 500-year-old double entry system obsolete.